Investors Chronicle.
Hello and welcome back to the IC Interviews podcast. I'm Dave Baxter, the funds editor on the IC, and today I'm joined by Alastair Laing of the Capital Gearing Investment Trust. Capital Gearing is among a few names such as Ruffer and RIT that seek to grow your investment over time, but also look for a balance in also trying to protect your cash during rough periods for the stock market. To do this, they use a mixture of different assets from equities to bonds and exposure to areas such as property. And like some of their peers, they have taken some pretty strident, candid views on what's going on in markets and in the economy. Alastair, thanks for joining today. How are you doing?
Morning, Dave. Very good, thanks.
So, as I mentioned, I mean, you may disagree that they're strident views, but they're certainly interesting views the team has tended to take. I think it would be good to start off just talking about your, I suppose, your general view on kind of markets, the macro situation, such as where we stand with inflation, and just how that is affecting what you're actually doing in terms of positioning the portfolio.
Well, it's a fascinating time. The changes to markets over the last couple of years since, the beginning of 22 and the everything bubble has been incredibly striking. There has been inflation, which has really entered the bloodstream of the economy as we analyze it. There will be variations in inflation, but it feels like it has embedded itself such that it's going to be a talking point for many years to come. That resulted in a major rebalance in the bond market. Yields have moved up from record low, multi-millennia low, back to a more sensible range. And equity markets have bifurcated in this extraordinary way with these pockets like US tech, maybe countries like India performing extraordinarily well. And then underneath it, you see pockets of fantastic value. So there's just this amazing range today, which is in such stark contrast to a couple of years ago where it felt like everything was simultaneously, valued for perfection. So there's a lot more to look at.
And where, I suppose, sticking with your kind of equity exposure, because you always need some to try and power that growth over time.
Yeah.
You talk about pockets of value. Where is still a pocket of value? I mean, lots of markets that were kind of pretty hated, the UK, Japan, Europe, have actually done pretty well in the last year or so.
Yeah. So we invest into the equity market through collectives. Wherever we can, we actually invest through investment trusts. So I'm sure we'll spend a bit of time talking
Yes.
about that. But, investment trusts simply then invest in a range of underlying markets. So we do have a view on all of those. I think for us, the real standout, it's a silverback gorilla in the room, is the US market. It takes up such a large share of investors' thought, and just the scale of the market and the companies within it. You've got 4 companies, I think, on the US market that are larger than the entirety of the UK stock market. It takes a lot of oxygen in the room, and everyone is currently thinking about the AI boom, Nvidia, Microsoft, and it's pretty extraordinary what's been going on over there. But we think that there are definitely signs of exuberance, things that would really concern us. And as you point out, in other markets, somewhat less fashionable at the moment, the UK, Japan, other areas, performance has actually been okay for a few years now, but they've had nowhere near the performance over the last decade of the US. So we think there's plenty of scope for a rotation in leadership, from those areas that have been such a phenomenal success over the last decade to some of the less loved areas. Yeah, and that stands if you invest in them directly, but equally through investment trusts.
So the inevitable kind of horrible question is, we talk about whether things kind of reverse, whether you get sort of regime change.
Yeah.
Is there a catalyst? I mean, it is a horrible question, but is there a catalyst we can point to for that happening? Is it just reversion to mean, or is there something else that could drive a change?
Yeah, we certainly don't believe that we can forecast a specific catalyst, a kind of
Mm,
silver bullet that changes things. I mean, it can happen. You know, if you looked at Japan, for example, a change in monetary policy there to increasing rates could have a very profound impact. For a holder of Japanese equities, you could see a situation where the currency moved very fast. So as long as the equities could maintain their value in domestic terms, in the face of rising interest rates, you could see very significant currency gains. That's just an example, but it is hard. Typically, what happens is these markets rebuild over multiple years or even decades. So Japan has actually been in a bull market for getting on 10 years now, and but 5 years ago. If you went to a Japanese manager presentation, there was no one in the room. Whereas if you go today, it's standing room only. Everyone's much more interested in the story. So it takes time to build.
and what is your kind of rough level of exposure to those equity markets at the moment? How much do you have in the US, and how does that compare with, say, Japan, the UK, and so on?
Yes, so just to frame that discussion, we have just under 35% of our portfolio in equities, with the
Mm,
balance being in a range of different types of bonds. Within those equities, within that 35%, we have about 18% which are in funds which invest into conventional equities. So you're already seeing we've got quite low weightings in conventional equities. And then we are very strongly skewed towards value markets, the UK, Japan, Europe. So you're down to about 3 or 4% of the portfolio, which is in US equities, because we're very concerned about that part of the market.
mm.
And for context, US equities make up in excess of 60% of the global equity index. So you'd expect them to be a majority, but they're actually a really quite small part of our equity portfolio.
How do you, I mean, it must be quite hard. I always think, we're having the kind of US concentration, frothy valuations conversation. And I think, I've had this conversation many times over the last not quite 10 years, but of course it's been a perennial thing. And it's been quite painful to take that contrarian stance, much as it does seem kind of sensible, or it makes sense.
Yeah.
How do you deal with that kind of like psychologically, and are there ways you can sort of offset the pain of being kind of underweight the US and missing some of those huge gains we've seen in recent years?
I absolutely understand what you're saying. It has been, we have been underweight the US for a long time.
Mm,
And, at some point, you've got to maybe hold your hand up and say that was the wrong choice. And the power of the business models that have emerged within the tech sector, we just underestimated their earnings potential. But it's also important to see how things have changed. Over the last 5 years, Microsoft has gone from a free cash flow yield of kind of in excess of 5% to sub 2% if you correctly account for the stock options. And that's on off the back of absolutely enormous capital expenditure um, going into AI, which may prove to be a gold mine, but equally it may not. They've not yet worked out how to monetize all of uh, the spending. The business models will evolve. There has been a change in valuation, and at the same time, some of the other markets have drifted off. So as the extremes have widened, that has been helpful. Something that's particularly relevant for us as well is we are hunting around the investment trust universe looking for value opportunities as expressed by discounts.
yeah.
So if that's a really important part of your day job, it's very interesting because it's a contrarian indicator. By definition, discounts emerge in areas that are unfashionable.
Yeah.
So for us, everyone wants to be a contrarian investor, but as you point out, it's psychologically very difficult to do so. But this is a measure that we can look at, a quantitative measure that pulls us to areas that are unfashionable. And that may mean that we arrive a little bit early. But over the 42 years that the team has been running Capital Gearing Trust, it's allowed us to build positions in markets that are unloved, in decent size, and over the medium term, that's delivered really strong returns for us.
Yeah, so we'll get on to trusts in a bit, but I just wanted to stick with, I suppose, the kind of broader investment mix. Another asset that looks unpopular by certain metrics is the humble bond, or perhaps
Yes.
it's not. Used to be the boring bond and isn't so boring in recent years. You've seen, yields have, as you mentioned, they've kind of come back to perhaps more, I suppose, conventional levels.
Yes.
UK 10-year gilt is on, I believe, probably somewhere around what, 4%
4%.
territory,
Yes.
something like that. And
4%.
had points government bonds had been around 5.
Yes.
Um, could you talk me through, because bonds are such a big part of the portfolio right now, but
Yes.
you, I suppose, have kind of interesting takes on what kind of bonds you're actually kind of taking big stakes on.
Yeah.
So could you just talk me through kind of the team's position there and what the thinking is?
Sure. So you can get in a huge amount of detail about bonds, but just stepping back, there's a few kind of golden rules that we have. Firstly, in the environment that we're in, where we believe inflation has become properly embedded, if you're going to take any maturity or duration within your bonds, we believe you want to do that with inflation protection. And that's a type of bond called an index linked bond that delivers a real return rather than a nominal return. Um, a real return means you get inflation plus something. So you don't have to guess about what inflation is. You know you are going to get a return in excess of inflation. So for our money, it is just simply not worth trying. It's simply not worth taking the risk of holding a bond with a maturity any longer than 3-4 years without investing in an inflation protected way. The main index linked or inflation protected markets are government markets. So we have medium duration bonds, i.e., 4-5 years in UK index linked.
Yeah.
That market was very before the Truss Kwarteng debacle.
Yes.
Trussmageddon.
Trussmageddon.
That market was extremely expensively priced. But it had a very dramatic repricing. So over the last year, we've been buying a lot more UK index-linked bonds. But then we have some longer duration bonds, just around 10 years, and we hold those in the US, being the highest quality market. So we think of our TIPS or Treasury inflation protected securities, US government bonds, as the highest quality. It's in the global reserve currency. It's inflation protected, so that is the true risk-free asset, and it's fantastic for us to have an asset of almost 10 years duration where you know you're going to get inflation plus 2% with very low levels of credit risk.
I suppose they're linkers as well. When the names goes, like they are quite unusual. They always strike me as quite unusual products for like a couple of reasons. One is they do tend to have kind of a bit more duration, so they are sensitive. When interest rates rise, they do feel a bit more pain. But also, what's interesting is the fact that they're kind of, I suppose, valuations can move around based on inflation expectations rather than what inflation actually is. So has there been a bit of pain there as people are expecting lower inflation, or has it been kind of roughly okay in recent times?
Well, we could talk for a long time about what happened to index linked over the last couple of years, and I'm sure some of the listeners would have been slightly scratching their head that, particularly marked in the UK at a time when inflation really started to rise, this part of the market actually performed quite poorly. But the first thing to say is that an inflation linked bond has two parts to it. You essentially have a nominal bond and essentially an inflation swap. And an inflation swap is something that increases or decreases in value based on the change in the rate of inflation. So often people think an index linked bond is something that will increase in value if inflation increases, but that would actually be a pure instrument called a swap. A bond, the actual bond element of an index linked bond, as inflation goes up, can reduce in value, and then offsetting that can be the swap element of the bond. So that's to say that as inflation goes up and interest rates go up, the value of an index-linked bond can fall, but it falls by less than an associated nominal bond.
Mm.
Um, that's absolutely what we saw in our portfolio. Our bond portfolio over the last couple of years didn't increase in value as inflation picked up, but neither did it fall. Whereas if you looked at the conventional markets, they had a very tough time. So the increase in the capital value linked to the inflation offset some of the sell-off in the bond market.
Yeah.
You can now get 12 weeks of an Investor's Chronicle print and digital subscription for just £12. You'll get instant access to our website and our app, plus the magazine delivered to your door every week. Check the terms and conditions in the show notes for more information.
And I wanted to spend a little bit of time just on how I suppose you kind of execute your investment views in terms of the instruments that you hold. So I was looking at some of your kind of literature, and it seems you hold a lot of kind of direct bonds rather than, for example, a bond fund. But as you mentioned, with your equity exposure, you tend to do that through the likes of things like ETFs. Could you, just kind of talk me through your views there? Is it the case that kind of there is more value to be found picking investments in bonds, but not so much with equities, or what's the thinking?
So, the heritage of our trust and our approach is very much investing into investment trust, closed-end listed vehicles, looking for discounts.
Yeah.
And if you went back 30, 40 years, capital gearing trust, that was made up a majority of what it did. But over time, I'd say pretty much since 2000, the late 90s, when it was clear that the equity market was extremely overvalued, the kind of way the trust changed its investment style was to bring in more bonds, which at the time were very attractively priced. And, it was a very early mover in multi-asset investing. Today, multi-asset funds are quite common, but 20, 25 years ago, funds basically held equities. And investing in the government bond market, we have a macro top-down view which guides us as to where to invest. But equally, you probably don't want to be paying high levels of fees. So we find it's a great way to access. We can pick these securities ourselves. Within our equities, we mostly invest in investment trusts. We do occasionally invest in ETFs for liquidity management or to enter a market quite quickly if we can't find an appropriate investment trust way to access that market. Yeah. But we feel that through specialist investment in investment trusts, we've been able to deliver, some very strong long run returns. So it's about portfolio efficiency, really.
And one, I suppose, final thing on the actual kind of composition of the portfolio. I noticed that you do have kind of a long tail of reasonably small positions. Some are even around, something like 0.1% type territory. What kind of analysis do you do on those kind of positions? And I guess, again, what's the thinking? Like, how can they add value? Is that just kind of building up cost and complexity?
Sure. Yeah, we do have a very distinctive style, particularly within our equity portfolio. So it's somewhere between fundamental investing. So we will have a view on the markets, but there is essentially something like a trading element to it. So we monitor over 350 investment trusts. As the discounts blow out, that will mean that we will start to build positions when we think that there's good value in a trust. And sometimes that value proposition persists for a long period of time and we can build up a large stake. But sometimes you will only build a certain kind of position and then the opportunity will go away, the discount will narrow for whatever reason. So there's quite a lot of transactional activity which is going on around the core positions in the portfolio.
Mm.
So yeah, we do end up with quite a long tail of trusts, but we can almost industrialize the process of monitoring discounts. That would be one way of thinking about it. And going back to what I was saying before about being a contrarian investor, the discounts take you into places that other people aren't looking at. But then we're quite disciplined at saying, as long as the underlying assets are fairly marked to market, then the discount's what's interesting to us. Can we impact the discount? Is it likely to come in? So we spend a lot of our time looking at those kind of technical dynamics, as well as trying to work out whether BP or Shell are better valued.
That's really interesting. So, yeah, you mentioned kind of valuations, and I suppose the big question many people are asking, which is whether they can trust a discount.
Yeah.
There've been a lot of interesting murky waters there, particularly when it comes to kind of private assets. People, Scottish Mortgage, for example, was on quite a big discount last year because people didn't really trust the valuations. And I noticed, you guys hold some infrastructure trusts. You also hold RIT Capital Partners, which has some private exposure. How are you kind of arriving at a valuation in those instances that you can trust? So that seems like such a difficult challenge for the many investors who are trying to kind of gauge those discounts right now.
Absolutely. And it's the fascinating feature of markets, the way pendulums swing back and forth. Back a couple of years ago, everyone was super excited about unquoted kind of unicorns in the portfolio, and that would often be a reason for a premium valuation. And then when trust in areas starts to fade a bit, it becomes a area of concern. And I guess at that point, it becomes more interesting for us, is the key point. The first thing to say is that we spend an awful lot of time looking at assets within the closed fund universe. There are lots of trusts that hold private assets. You build up a network of contacts that you can use to provide some level of due diligence. But the second level down is around what Benjamin Graham would have talked about as a margin of safety. If those assets where you do have a big discount, you can actually go and look at something like a portfolio of private assets and say, well, maybe these aren't right, but if I take 20% off the valuations here, 30% here, this one I've referenced with a third party, it sounds like it's going fine, so I'll only put a 5% haircut here. You can end up with your own fair value discount kind of calculation. And as long as the discount available in the market is wider than your fair value, then you're off to the races. But the other way, of course, that a trust can try and prove up its private market valuations is by disposing of those assets.
Yes.
So we also will engage actively with boards and try and persuade them to go and sell underlying assets. And certainly in areas like infrastructure, you have seen, out of the trust sector, well over $1 billion of disposals have occurred at or around underlying NAVs. That capital is then used to de-gear, to buy in shares. And if it's one disposal, then you're going to still be questioning it. But by the time you see multiple disposals come out, you can start to kind of estimate an NAV range. And really what we've seen a lot in the investment trust sector is a whole variety of technical issues. You had a lot of buyers who were very attracted by high yields, relatively high yields, a couple of years back when government bonds weren't an issue. Weren't an attractive investment. Now the yields on government bonds have snapped back. You've seen investors move out of alternative income vehicles into the government bond market. This has thrown up big discount opportunities, and essentially we are now moving the other way somewhat. We are now moving into those discount opportunities. So it's an example of a kind of counter-cyclical approach.
As you'd expect, I've written a huge amount about the kind of investment trust bargain kind of situation in the last year or two. But something that fascinates me is, yes, lots of stuff looks cheap, but it's also the due diligence has to be pretty high right now because there's so much disruption in the space. consolidation amongst wealth managers means that
Yes.
trusts need to be even bigger to survive. You're seeing lots of M&A, you're seeing lots of wind downs, and even if you're kind of managing to get out of a trust at NAV because that make a profit, it's quite disruptive for someone trying to run a portfolio.
Yeah.
How do you guys kind of navigate that? I mean, I had a look at some of your kind of holdings. You've got some quite big names like Greencoat UK
Yes.
Wind. You've got Hickle. Quite.
Yeah.
Are you just tending to like back the bigger trusts as kind of one way of avoiding some of that headache, or what's your approach?
Well, I'd say the market has actually changed in our view quite a lot over the last 12 months. Sure, discounts were pretty wide 12 months ago, but they were very specific sectors, a lot of private assets, so private equity, and there were questions around the valuations. I think some of the leverage buyout areas we were always concerned were a bit more exposed than, for example, infrastructure, where you tend to have more stable underlying businesses. And then you had some kind of tech names. So the discounts were in very specific areas. What we've really seen is it broaden out into what I would call the banner names, the absolute long-standing brand name trusts. And this is very exciting to us. You know, a lot of these will be familiar with your audience. If you think about conventional retail trusts like Finsbury Growth or Smithson, which is Terry Smith's smaller cap fund. You can then go in the diversifier space, BH Macro, RIT Capital Partners, and then into alternative income space. You've got the likes of Hickle, IMPP. These are all areas where there are very significant discounts. The due diligence on these kind of long-running vehicles is still needs to be done. It needs to be done carefully, but it's very different from the kind of due diligence you maybe would need to do off a smaller trust in a area like venture capital. It's maybe got a short track record. The asset values are less certain. So we think that the environment now in investment trusts is as exciting as it's been really since the global financial crisis. And there's lots to go at. You don't have to take risky positions in small companies. You can buy some of the biggest names out there. Yeah.
So a quick scramble to the AIC website tells me that the private equity sector is currently on an average discount of 31.5%, and that's even when you're including, 3i Group, which is on an eye-watering premium right now.
Yes.
But is the team still are you quite bearish on private equity, or have you been kind of taking a nibble at all?
Well, we're constantly looking. We find it difficult to build the same level of conviction in private equity here in that sector. Would be talking about funds that are holding highly leveraged private businesses, typically in the medium-sized businesses with quite high levels of leverage. So there's quite a lot of risk inherent in that. The rewards are great if you get it right. So we absolutely have been looking. The way that these funds organize themselves and are returning capital to investors has made them much more interesting proposition from our point of view. However, still our main focus is elsewhere at the moment, because we believe that the risk return on some less complex vehicles to analyze and go at, there's just a lot to look at the moment. So, and I guess another feature about the private equity funds is they do tend to be quite US focused. So you'll have a lot of US tech services, some kind of high end areas of industrials. And our concern would be that if the US markets went through a period of weakness, you'd see some NAV write downs into kind of quite leveraged positions in those funds. That's not to say they could be great investments. They've been very strong performance for the last 10 years, but right now we just don't feel like we need to go there in any size.
Yeah, that makes sense. And have you generally been quite, I suppose, positive when it comes to share buybacks? Because I suppose, as with UK companies in general, trusts have been piling in there. You mentioned the, private equity trusts have kind of realigned their, I suppose, approach in some ways, and focusing a bit more on dividends and buybacks, and just across the sector more generally, you've seen loads of buyback activity.
Yes. So we are great believers in buybacks. The trust that we run, Capital Gearing Trust, has a discount control policy, so we will buy in shares or issue shares close to NAV. And this does lead to some variation in the size of the company, but that's fine as long as the underlying portfolio is sufficiently liquid. We see no reasons that discounts should blow out and punish investors at the time that they, typically during a bear market. So a long-running complaint about investment trusts is you get a double whammy on the way down. It feels great on the way up, but you can get hit pretty hard on the way down. And the other thing, the really obvious thing, is share buybacks at big discounts are very NAV accretive. So just from a point of view of capital allocation, if you're buying back on a 10 discount, then your return is 10 over 90. So you're getting low teen returns risk-free. It is as close as you get in the financial markets to a true arbitrage. So we just don't understand why a director would, for a trust with a liquid underlying, would ever need to think about buying back in scale when you have that risk-free kind of opportunity to increase NAV and ultimately shareholders returns. So we're big fans. There are areas where it becomes more complicated, particularly for vehicles with private assets. But at the end of the day, it's not rocket science. These companies often raise money at a premium and then invest into assets. If they go to a discount, they just need to do the reverse. And it's very telling. You never see a director coming along saying, I've got this insoluble problem. I'm trading at a big premium. I just don't know what to do about it. They always know what to do about it, which is issue a lot of
Issue loads
shares.
of shares.
It's exactly the flip side is exactly the same. You just have to dispose of assets in the market, buy in shares. It's very straightforward.
Although, I mean, there is an interesting argument some trusts have made. I think the chairman of, maybe it was Invesco Asia Focus or something, or a year or so ago, made the case that there was loads of kind of value in the underlying market, and they effectively did not want to stand in the way of that by allocating capital to buybacks.
So I don't want to be rude or disrespectful, but I just don't think kind of mathematically that stands up. If you buy in shares, your investors remain exposed to exactly the same portfolio. You can sell 10% of your underlying portfolio, buy in 10% of your shares. Your investors remained exposed to exactly the same portfolios, exactly the same opportunities. You have just, if you've bought back 10% of your shares at a 10 discount, you've just added 1% risk-free to the NAV, and your investors are left with exactly the same portfolio exposure. So to me, yeah, as I say, it's very telling that you wouldn't see a 10% premium in any trust for any period of time. Boards would quite rightly identify that issuing at a 10 premium would capture NAV uplift and allow them to grow the portfolio. And you just need to have an equal and opposite response when discounts emerge.
Yeah, makes sense. I suppose if I'm going to be a doom monger, I am right now. I could make the case that as much as investment trusts look cheap, the sector seems to be threatened with a bit of structural decline because you are seeing wealth managers, so some of the big buyers of investment trusts are consolidating, getting bigger, and that means for liquidity purposes they need to hold larger and larger trusts, and the threshold for what's acceptable rises. Interestingly, Peter Spiller, I think, recently spoke about realization shares as one kind of tactic, but are there ways in which you think this decline could be reversed? Or equally, would you disagree that there is such a kind of decline going on?
Yeah, I mean, the last couple of years have been very difficult for investment trusts. The backdrop has been one, certainly after the end of 22, of markets globally, and particularly in the US, roaring off, and investment trusts remaining stuck in the mud. So that has led to a very kind of pessimistic backdrop, these discounts opening out. But just to step back a bit, over the last 20 years, investment trusts have grown from aggregate assets of 50 billion to over 200 billion. That's about a 10% compound growth over 20 years. That's been 6% capital growth. There's also been some issuance. There's been 3% dividends paid out, but that obviously doesn't add up to the stock of assets paid. But that is far faster than the UK market growth in general. The performance of investment trusts has been way ahead of UK markets in general, very close in line with the global index, even though it's relatively underweight some of these US areas. So it's been a very strong performer, and investment trusts have been around for 155 years. They've made it through the Second World War, crisis in the 1970s. There's a good chance that something that's been around for that long will continue and will prevail. And for us, we think the most likely case, there was a very similar debate in 2010, 2011. Are investment trusts over? People looking at the landscape. You had a lot of, for example, fund of hedge funds, various other kind of exotic vehicles that had appeared over the, before the financial crisis. And there were 2-3 years of tidy up that occurred as larger increasing buybacks, companies getting taken private, companies winding up and returning capital to investors. And a bit like as we were talking before about the UK and Japan, underneath it in a very quiet way, it was a market that was actually performing well. Everyone was still feeling very negative about it, but the bounce back in performance happened whilst everyone was still feeling quite concerned. And really by 2015-16, those discounts had largely disappeared. And indeed, we moved into the narrowest discounts we'd seen. 2021 was the largest year for issuance other than 2006. So my sense is the pendulum, it's most likely that the pendulum swings back and forwards. People are very concerned now. But I think it's very likely that actually we're about to see a period of very strong performance. However, I would say from our point of view, even if we're wrong, even if we're over the next decade, this whole sector is going to be just wound up. It doesn't matter for us. We are looking at interesting discount plays that are going to disappear, and that will be a profitable trade.
Yep.
So there's an element of being agnostic, although we would be very sad to see investment trusts disappear. We think it's very unlikely.
Yeah, well, hopefully that doesn't happen. We'll be watching that closely. Well, I'm afraid that is all we have time for, but a very interesting discussion, lots of food for thought. So I'd just like to thank Alastair for coming on. I'd like to thank our very talented producer, Maddie Apthorpe, and thanks to you for listening. Take care.